Alright then, welcome back each and every one of you. I am so sorry I've been inactive for a while because I've been way too much occupied with a lot of stuff, but here I am right now back with another really valuable video in which I'm going to provide a lot of knowledge and my own perspective on how I look at the charts through my journey. And it's all for free, of course. It's all for you people, those who are struggling to understand the market, those who are really willing to grow, and those who are in this journey with me together. I welcome you to this video in which I'm going to be showing you how I do the top-down analysis, right? There are a lot of small little golden pieces in this video, so make sure that you watch the whole video. And as always, I'm going to bore you. It will be an extremely boring and lengthy video, and I'm happy that I make you bored. Actually, that's how I know, the people who are watching. So let's begin. Suppose I come to the chart, right, and this is the new month. Let's suppose that I start the chart at the new month. Okay, I am really excited to begin, and I come with a fresh mind. What do I look at? Firstly, the number one thing I want to make sure I follow is the EBITDA data range, where the price is located in the previous day look back, right, and where it will be in the coming days. So new month starts, I put the horizontal vertical line over here which depicts this thing, new month, and I go back 20 days. Look exactly 20 bars. All right, make sure that you go back 20 bars, not 28 days like as it's mentioned. 20 bars it actually calculates. So 20 bars over here backwards, 20 bars forward, you delineate these two lines right there. Now 20 days look back, you mark the highest high and you mark the lowest low. Now if you want to make sure that you understand EBITDA properly, I have another video on my channel which you can check. Right now I want to know that you've been watching the videos, and there is something which I mentioned in the video which states that if the high or the low of the previous 20 days, if it's swept through, it will seek liquidity on the opposing side. But if it is traded through like it's happening over here, it's being traded through, and now we are bouncing over here, right? Now these are the two scenarios. If we trade through it, this one particular high will act as the flip zone. Make sure you write this down, and since it's fractal, whatever is happening on the lower time frame or the higher time frame happens on the lower time frame as well. All right, so EBITDA data range, we are in the premium zone, right? Over here you can see, sorry, this is the equilibrium, this is the low, this is the high. Now we have flipped it. You can see we have traded through, price has delivered higher. Now if you were to short over here, you were thinking of shorting over here, you would have been stopped out. Why? Because personally I didn't see any reason to short right there, because there was no setup formed, not at the particular times, nor was it logical. The understanding over here is you don't know whether the price is going to sweep it or the price is going to trade over and then find this support zone, right? So I'll be realistic with you guys, very realistic. There might be a possibility that you would have hit your stop loss over there, or some one of you, either one of you, anyone would have been stopped out or blown their accounts or anything. It's totally understandable, it's totally logical, but that's where risk management comes in. One trade goes wrong does not mean that the whole market is wrong. All right, so learn to adapt. Where we are in the market, either we are in the premium or the discount of the dealing range right there. We are in extreme premium, but here we don't have the narrative to short. We don't have the narrative actually, right? Why? Market profile. See, I'm keeping it really simple for you guys. EBITDA data range, we are at the premium or discount, we are at the premium. I have to short, but I don't have the narrative or logic. Why? Market profile. What's the market profile? You should know in a bullish market scenario, price moves up, right? Ranges, rejects the lows, breaks the high. Ranges, rejects the low, breaks the high. Again, it will range, reject the low, again break the high. This is the whole idea of market profile. Okay, right here, firstly over here, we reject the low, break the high. We reject the low, break the high. Again, we reject the low. Now this might be a scenario that why not we just short from here, because there is a change in the market structure, right? There is a change in the state of delivery or whatever, market structure shift, change of character, whatever. No, until and unless we reach a higher time frame PD array, the market profile will always follow its protocols. All right, suppose this is a 5-minute time frame or a 15-minute time frame, it will not stop delivering like this until it reaches a 4-hour time frame PD array, a higher time frame PD array. Understood? Lower time frame price action, a higher time frame PD array. Let me remind it and repeat it. Lower time frame price action, higher time frame PD array. These lows are supposed to be rejected. Why? Because smart money is buying. This is the sponsorship of smart money. You get it? How do I know I don't want to short? Because of the market profile. Even over here you can see rejecting lows, breaking highs. Again over here, rejecting lows, breaking highs. And I have a scenario over here, rejecting lows, and this is the major scenario. Look, lows rejected once, twice, thrice, broke the high. So on a lower time frame as well, if I'll go on an hourly, you will see the same thing, and this is like something which I did not see actually. Let me just see once again. Right, lows rejected right there, highs broken, low rejected right there, high broken, right? Rejected, broken, everywhere. You'll see it everywhere. Rejected right there, it's mentioned already. So let me just, low rejected, high broken. Let's see over here, low rejected, high broken. Once again the same scenario, low rejected, we didn't break quite yet, but right there we have a break, and then again and again and again it's going to repeat itself. Lows rejected, right there we actually have this thing, we might have a SMT right there. This is SMT in another pair. Highs broken, you can see it everywhere actually. Lows rejected, highs broken, right? Even over here you can see, I don't know why it's shaped like this. Lows rejected, this is current price action. Today I called this one little scenario right there, I caught this trade as well. So lows rejected at the perfect time, 9 a.m. candle, highs broken. So this is it, this is the whole idea. How do I know and how do I probe the market? This is the only thing which I wanted to mention, make sure that you understand. Market profiling is really, really important, guys, really important, because this might be the thing which was missing. You want to make sure that you understand the profile of the market. Are the lows being rejected? If yes, then the highs will be broken. If then principle, simple, keep it extremely simple. Where is price located currently? Where is it located right now? Now I see on a 4-hour time frame, in this range we are in a premium. Now will I be stupid enough to buy over here thinking that it's gonna go up? No, I would have been a stupid idiot who would have bought over here if it was my early ages, early days, really, really early days. I would have been like, yeah, the market's going up. Look, all these candles, it's going up. Now I'm gonna make millions of dollars, and then boom, account blown. No, if I'm over here in a range, if I'm in a premium, right? Unless and until I have a proper narrative that the price might come back down, and then I'll look for a long, then it's okay. But if you are blindly following patterns and then just want to trade for the sake of trading, your account's gonna get blown. Trust me guys, it comes from real experience. I'm not selling you anything. I'm genuinely making sure that you understand this and you do not blow your accounts, and you just prosper. That's all my intention is. So where is price located? If the price is located in any given range, if it's located in a premium, I don't look for buys. Even if my bias is bullish, I will not look for buys. I'll just simply wait. Right? Suppose I see there is an FVG right there, 4-hour FVG, right? Oh, there is a 4-hour FVG, and why not I just short from here? Do not short it. Why? Market profile. You do not short in a bullish market. You do not counter trade. If you are really a pro and you can manage your mindset and your capital really well, go for it. For me, no, I won't do it. So we are here. Where is price located? Right there. Now what do I do next? From where is price coming from? Firstly, where is price located? Is it in a premium or a discount? But from where is price coming from? Where is it coming from? From a low. Right there. This low. This was the CRT, right? Lows rejected. Let me just delete this so that you understand. This was the CRT right there. Low was rejected here. High was broken. Now, if price is coming from here, where do you think the next draw is? Where in this? Be really understandable, and it should be understandable to you, because everything is really clear. Where do you think the market will go from here? Quite simple. It's gonna go right there, right on the high, right? And if we are somewhere, just give me a second guys, I'm so sorry. Yeah, your eye should go right there. This is your eye, the extreme high, correct? But there is an FVG right there, which might act as a precursor to draw price back down into the discount and then push up. You understand? There is a possibility that price from here, it might just start reacting towards the discount and then push back up. Why? Because it needs sponsorship. If market was just going like this, everyone would have made money. No. Profiling, that's why. There is always a range after a expansion. Reject the low, break the high. Range, okay? Reject the low, break the high. So you just, any pop below any particular low, right? Not any particular, I'm sorry, any timed low, as over here on a daily time frame. See, Monday high was taken, Monday's low was taken. Now there is an FVG right there, a major FVG, right? Now you don't want to directly buy the moment Monday's low was taken. No, you want to make sure the whole idea is there. Why? Because we trade CRT, and CRT is the peak, for me, the peak of technical analysis, because it just gives you the draw on liquidity really easily. It gives you the draw really easily. It's up to you how you take it. Now, just give me 1 second. Where is price coming from? Right there. Where is price likely to draw? The opposing range. You have two ranges. This is it. This is a one range. Okay. This is here. Just simple, guys, simple. Proper support and resistance kind of way. Okay. Price is right now traveling from open. You want to be bullish, right? Where will you buy if you're a bullish? You know your bias is bullish. You're going to buy below the opening, right? See price going sideways, and then all of a sudden it breaks. You'll be like, oh yeah, there we go, we had a breakout right there. Price even reacts a little bit, all right, giving you the confirmation that yes, it is, and it wants to go up, and then you go there. This is the actual, you know, manipulation. This one right there, not the first one. It's the fake one. This is the actual one. Reacts from a key level. This is the zone, one zone. It can be a buy side, sell side, whatever liquidity. It can be an order block, it can be an FVG, it can be anything. It can be a breaker block, a rejection block, whatever. Price gives you a reversal. Now the moment it gives you a reversal, your eyes shall draw to the opposing range. It can be a CRT low. This is your range high. But since there is a possibility that price might just not go up, it might come down here, what will you do? Are you gonna kill yourself here because you know your point of interest was not respected? No, that's where risk management comes in. So who cares if you just lose one trade? Who cares if you lose 10 trades in a row? No problem, you come back. Now a real scenario is price opens, ranges, false breakout, confirmation of the false breakout, and then keeps dropping down, and then it gives you a reversal, SMT, and this might be the breaker or OTE, and then it expands, giving you one final low will be taken, case of death, and then the drawn liquidity is reached. So here price rejects lows, breaks the highs, right? Rejects lows, finally breaks the high, and then reaches the exhaustion. Where were we? Where is price from? Where is price coming from, and where is price likely to draw? Now how do I incorporate this with my own ideas, right? You look at major lows, you look at extremely, you know, important lows, and firstly you want to make sure when you're like this on the chart, you make sure you want to point out the 9 a.m. candles highs and lows of previous days, previous sessions, whatever. You go back, okay, you make sure you point out the 9 a.m. candles low. This is the 9 a.m. candle low. In this scenario we are bullish. 9 a.m. candles low, right? This is the 9 a.m. candles low. Here, over here, if I'll delete everything, if I'll just give you a naked chart, okay, this is the 9 a.m. candle low. Here if you'll see, price went back up into this FVG, dropped below, right there, see, 3 p.m. session, then it just went sideways. Now you know once again that once we drop below into this one candle right there, the timed range, you know this manipulation right there at 3 a.m. will be a major manipulation. Why? Because previous day's low is right there. This is the Tuesday's low, and Wednesday being the third quarter of the whole week, it is highly important and highly highly probable, and there is a possibility that the price might drop below at the particular time of London session, and then it might never see this low taken. This low was respected right there, you would see, and then you see price moving up all the way. And for your information, yours truly caught a trade in this one, this leg right there. We had this major order block which was formed when 320, which acted as a major support, right? Why? Because of time. A timed PD array is held in time in itself, all right? And you'll see it in every single day happening. Every single day this happens, all right? Now price is just literally drawing towards where? The opposite side. So from the beginning, this is how I see it. From the beginning, where am I in the EBITDA data range? Am I in the premium or discount? All right. If I'm in the premium, is there a logic behind me shorting? Or if there is no logic for shorting, I'll still look for longs. Why? Because of market profile. What's market profile? Why am I longing in the market? Price is rejecting the lows and breaking the highs, rejecting the lows and breaking the highs. That's it. Where is price located currently? In a particular price range, if the price is located in a premium or a discount. If it's in a premium and I am bullish, I will not buy. I will wait for it to come back into a discount, correct? If it's in a discount and I am bearish, I will not look for it for a short at discount. I'll wait for it to come into a premium. Simple. From where is price coming from? From where actually is the price coming from? Is it coming from a major time-based PD array, or if it just reacting from any random level? Time-based PD array I just showed you, 9 a.m., 10 a.m., whatever time, 3 p.m., 3 a.m. These are major times. So from where is price coming from, and where is the price likely to draw? One side of the range is taken, the draw is the opposing range. Simple. One side taken, opposing range. No, if we do not go, there is always the 50%. You take half of your position at the 50% and then let the remaining trade go on. All right. I kept it extremely simple for you guys because that's how I would understand myself. Okay. I will not go into the nitty-gritties of anything else. I hope you understood a little bit or something about the top-down analysis. You don't have to go to the monthly or, of course you have to go to the weekly time frame. Yeah. But if you want to look at the monthly time frame, okay, I'll give you something really important to note. For a monthly time frame, the major thing is the high of the previous month, the low of the previous month, okay, and you mark the openings and closes right there, and the new month's opening. These are the only major zones which you should be looking at. Of course, if there is a monthly FVG or a monthly breaker and something, price might react from it. But at the advanced level, when you're trading on a intraday level, you don't have to go all the way there. Just keep it simple. And weekly chart is of course very important as well. You look for CRTs on a weekly chart and then you profile the market as well. Rejecting the lows, breaking the highs, rejecting the lows, breaking the highs. Right there, rejecting lows, breaking highs. Correct? Everywhere, it's everywhere, literally. Over here we have not really. Yep, rejecting the lows, breaking the highs. Again, rejecting the lows, breaking the highs. Why I'm repeating this is because repetition teaches. Okay, if not, go to the daily, look for your EBITDA and follow the protocol which I just mentioned. So I hope you enjoyed and learned from this video. I'll see you in my next video, and good luck and good trading.